Director Gallagher.
Here.
Julie Peterson.
Here.
Michael Brandes. Absent. And Jessica Dixon. Absent. Chair Pimentel.
Anybody or any, changes to our start date?
Yep.
Yeah. Audit and IGT. Public comment.
The year was really wonderful. I was missing yesterday, or the other day, and
Okay.
love our services.
Oh.
Sorry, who was that? Who?
Oh, Kristen.
No, but who, you said you were missing
I was,
someone?
no, I was in the ER.
You were testing that.
That's right, I was, so that's my public comment. I love Watsonville Community Hospital in the ER.
Nice. Happy to hear it and sad to hear it at the same time.
Any comments? Great.
I do not see any hands raised.
Move on to our items for today. On consent, we have one item, approval of our minutes from March 25th and April 29th. Move approval of those minutes, March and April of 2025. Great. Do we have a second?
I'll second that.
Great, thank you, and Director Gallagher, and all right, I'll take roll on that item. Director Gallagher?
Yes.
Julie Pearson?
Yes.
And Director Chair Pimentel?
Yes. Here's the financial report.
Okay, give up the presentation.
Okay, ready.
All right, very good. Okay. Well, we are continuing to have some financial challenges when we compare ourselves to budget. The month was another unfavorable month with a net loss of about $860,000. As you can see, it's primarily on the net revenue side. We've had very soft volumes, and I'll get into more of that in some of the future slides. We are, behind in implementing a number of our initiatives. A couple of things that I did want to point out on the month to date is that while we're favorable on the expense side, and we've talked about this before, it's hard to be completely favorable given the staffing and things that we need to do regardless of low volumes. So we have been trying to, dive in a little bit and say, well, are we flexing enough? And on labor, we are not, and I've done a little bit of an analysis where we try to separate out the volume portion of our variance from the rate portion, and I estimated that in this month our labor would be unfavorable about $160,000, even though we look overall, favorable by $673,000. We do a similar analysis on the supply side, and look kind of from a rate and a volume. And the favorability that we have on supplies is pretty much on par with where we would expect to be, just looking at it from a per adjusted patient day type calculation. And then the one new thing, and we're going to continue to break this out even a little bit further starting next month, is we're kind of as a result of the audit and our learning more about how to account for some of the bonds, we now have a bond interest payment and with the county tax revenue that we're basically accruing to pay out to the bondholders, as well as the interest that we're earning on the dollars that we still have from the bond proceeds. The accrual for the payout is in that lease line item, so we are going to get that broken out because that's got a number of things in there. So for next month, we'll have that broken out, and then we'll break out, anything else that, this non-operating income is pretty much, the bond interest income, but we're gonna basically try to have the bond stuff always, kind of showing on its own, as opposed to other things that fall into those categories. Slide. It did not. Okay. So on a year-to-date basis, we do continue to have the low inpatient volumes. We have revenue initiatives that we haven't implemented. Of the $8.3 million impact up there, I'm estimating about 3.2 of that is related to basically the lower volumes for those reasons. We've also, then I look at it from kind of a collections, service mix, meaning, maybe we're doing things that have higher or lower charges at a different pace than what we budgeted for. And I have estimated that shortfall is about $3.4 million. And the rest of the shortfall is really primarily relates to some of the projections we did for QAF 9. We knew it wasn't going to hit us this early in the year, wasn't going to be approved and ready this early in the year. But the way the budget ended up being spread, some of those dollars are, kind of loaded up front. I think, had we not had the cyber attack and our kind of mad dash to finish up that budget, we probably would have been a little bit tighter on the budget spread for the year. On a year-to-date basis, kind of doing the same calculation I did for labor efficiency, I'm noting that on just kind of the productivity standpoint, there's probably about a little over $500,000 in unfavorability in what is otherwise, it went back. Yeah. And that $1.6 million that says we're favorable, that number should probably be something closer to 2.1, 2.2 million in favorability, but we're trying to figure out ways, knowing that we can't get all the way there with staffing ratios and things, but how to become more efficient. And again, the supply variance is pretty much in line with where I would expect it to be at lower volumes. Next slide. So on the stats, admissions were low. We had low length of stay, so everything just related to almost 234 less patient days than what we had expected. That's a lot of staffing to try to absorb if you think about it. We had a much higher case mix this month, and I dug into the case mix a little bit, just kind of quickly comparing this month compared to last month, and where were some of the higher weighted DRG cases that will drive that case mix up, especially kind of comparing to what it was last month. And it was interesting because there was about 11 cases, not including anything to do with NICU and babies, but that had a higher relative weight, greater than 2.3, and our whole rolled up one is 1.5, so that's significantly higher. And it usually takes a few, pretty high cases to kind of move the needle. These were like 11 more cases than in similar DRGs than what I saw last month. So I really only kind of zeroed in on the highly weighted cases. Also saw that we had more babies that were, some of them fall into the DRGs related to being a premature baby, and others are full term, but there's two different ones with major problems, ones with significant problems. There was quite a few cases this month there. And then on the inpatient and outpatient surgeries, we primarily, inpatient continues to be above budget. We primarily saw the increase in OB cases. You can see, more than half of our inpatient surgeries were OB cases, C-sections, and then other things that fall within the surgical realm. And then on the outpatient side, we primarily saw increases in general surgery and, again, OB/GYN. And really what explains our shortfall is the fact that we haven't opened the cath lab yet. Next slide. Yep. Yes.
Patient days, like 813 for the lowest one, 12 months. How do we get to that number? How do we get to 813? Is it patients who control the cumulative days, patients who stay in the hospital?
Yeah, it is. And if you think, we've got an average length of stay of 3.07, which is relatively small for us, If our budgeted length of stay is up closer to 3.4, 3.5, actually it's right there, so almost 3.4. So, 0.3 of a day for every patient shaved off there. And then we had, 265 admissions as opposed to a budget of, so that's really what drives the lower patient days. It's really primarily driven by the fact that the lower length of stay, I mean, they're staying, 30% less as long. I don't know how to say that. And you'll see when I get to the one slide where I show the admissions, I've got a couple comments there because I go all the way back. We can go all the way back a year and kind of see where it's gone. Next slide. So, kind of the key things on the year-to-date. It was interesting, because we've been talking every month about admissions being down and being below budget, 12%. We actually have 16 more admissions year-to-date April than we did last year-to-date April. Now, we know that we had budgeted for some things, expecting to do more work in the pediatric admissions that we've kind of deferred for now. And so that's really explaining some of the shortfall is really related to initiatives that we haven't rolled out. And seeing a lower percentage of admissions coming from the ER than what we were seeing. Length of stay, better than we were last year and really kind of on a year-to-date basis closer to where we had budgeted. The case mix isn't quite up to where we were at this time last year, and it's kind of interesting to note that we've seen a little bit more in the transfers from the ED being up this year. So that was something we were talking about earlier in one of our meetings, and kind of just trying to think through some of the reasons which come with the stability of the providers that we have, and always, of course, when the particular cases are coming up. The last year at this time of the year, we also had a longer length of stay, which is really, when you look at the average daily census having a 5.5-day difference, some of it is really related to the fact that the patients were staying longer. And we already talked about the cath lab. So here's that admission slide, and you can see that, April 25 versus April 24, they're pretty similar, only 3 difference. But we really, for the most part, we have a couple of these spiky months where we get up over 300, but we're really fairly stable in that 265 to 280 range generally. Here's the case mix, and if you take out the first 4 months of this graph, which were the April 24 through July 24, where we had a little bit higher case mix, and then things dropped off, and just look from August forward, you do see that, generally speaking, we're starting to inch up, and there's been a lot of focus on the queries that we do to physicians to make sure we've got the most accurate documentation, capturing all the complications, comorbidities, things that are done, so that we make sure that we're coding the account to the right DRG, get the right reimbursement for what we're doing. So it's good to see some of that work coming out. Even when I was drilling into the case mix a little bit, I was looking at sepsis cases because that's typically where, you know, we have a good 45 to 50 sepsis cases a month, and there's, you know, a few different DRGs there, and, you know, just watching, are we, you know, moving the needle at all in terms of the allocation between the three different sepsis DRGs. We really only use two of them. We don't have the highest acuity sepsis patients, but looking for little indicators like that that say we're you know, making some progress there. Slide. Average daily census, as we've seen, you know, generally has been trending down since about November of last year, and as we've seen, like the stay has really played a part in that. Next slide. So the outpatient and ER visits, you know, ER, we averaged 92 patients this month, so it wasn't necessarily quiet, especially in a little 12-bed ER. 92 is still a pretty hefty day. But you can see a slight downward trend there, and meanwhile, the outpatient non-ER visits kind of continuing their upward trend. We had a pretty strong month in April with 3,745 non-emergency room visits. Deliveries, after kind of having a shorter month last month, really recovered in April up to 72. So I'm still saying that the trend we've been looking at since about June is an upward trend. So that is interesting, especially as I kind of think back to the case mix observations made about some of the patient conditions for our babies. Here on the surgeries, so pretty strong month with the inpatient surgeries. We had 62 inpatient surgeries, and really we've seen the largest increase in GI surgeries and OBGYN cases, and the largest year-over-year decrease has been in ortho and podiatry. Now we know we had lost one of our ortho docs, and so that explains some of that. On the outpatient side, saw an increase, the largest increase year-over-year has been in ENT, and on the outpatient side, general surgery and ortho have been the largest decreases. You know, we have some movement going on right now with some of the surgeon cases, and in most of our modalities, the numbers are still relatively small. Many of them are single digits or, below 20. And it's really things like the general surgery and the OBGYN that drive a significant portion of the volume. So on the payer mix, this has been interesting. I took a moment to look at it, not only at the kind of percentage change, but also the year-to-date over year-to-date prior volumes. And so, April, we did not have a strong commercial mix in April. We were just at 12.8%. But as I looked at April year-to-date compared to the prior year-to-date, we were actually 20 admissions more in the first 4 months of this year. And the Medicare, we're down about 14 admissions year-to-date compared to last year. Managed Medi-Cal, or the Alliance, up 24, and self-pay was down 13 admissions. So those are some good kind of indicators for us, in watching especially the commercial mix creeping up and the self-pay not creeping up, and in this case, being reduced. And it's even a little bit more telling on the outpatient side. From the outpatient side, our commercial mix is up 0.5%, and that's 315 outpatient visits more that are commercial. And just moving from March to April, we had 102 more commercial visits in April. And I didn't do a slide, but I had also just kind of peeked at emergency mix, just emergency case mix and, or not case mix, but, payer mix within the emergency cases. And the most significant increase again was in the commercial patients, more growth there. Medicare is up 107 visits year to date. Managed Medi-Cal, which we know that's always our heavy hitter, and they're up 486 visits year to date. And self-pay visits are down by 208. So again, I think some good indicators for the commercial growth that we're trying to bring forward here. I'm going to take a little pause before I go into a couple cash updates and see if there was anything you wanted to revisit or ask about.
A couple things, trying to interpret average length of stay. This makes sense. Financial standpoint. Given DRGs, is everything paid on a fixed amount, so the shorter length of stay, financially less expense, more net revenue? Is that generally true?
It's true on Medicare and to a sense, Medi-Cal is paid on the APR, DRG. And we have some, but very little else is paid on it, like a percent of Medicare. You have some, like your managed Medicares and stuff that are a percent of Medicare. We still have cases like in the commercial where they're paid, we're going to get so many dollars per room and board. So if they're here longer, we're potentially going to see more revenue there. But, the bulk of our business is going to be tied to having a strong length of stay, which we're very tight on the length of stay, and getting that physician documentation and all the documentation to support, the highest reimbursing DRG that we can compliantly do.
On the case mix index, with a higher case mix index, on balance or on average, get paid better, or?
It does. If you think of, you have a base rate. I mean, the easiest, not necessarily easiest, but one of the kind of quick and dirty ways is you look at the base rate that you get paid from Medicare as kind of a minimum payment. You're going to get better for your commercial cases, but you take that base rate and then you multiply it by a case mix. So, just multiplying by 1 versus 1.5 makes a big difference. Yeah.
Thanks.
Sure. All right. Let's look at I just have a couple slides. So I call this my dynamic cash forecast because every day when I input in today's cash collections, it changes. And sometimes for the better, sometimes for the worse, because it's all dependent on what I had already forecast in there and if it was a better day or not better. But this is, as of this morning, my forecast just going out to the end of 26 and trying to watch, what are things looking like, and, where do I have QAF payments coming in, and the bigger ones. I didn't put, sometimes like today we got a smaller one, but the bigger ones that come from the directed payment through the managed Medi-Cal plan. And then the new IGT payments, and we're going to be talking, one of our agenda items here is about executing an agreement to participate in one of the IGT programs. We're trying to get into 2 intergovernmental transfer programs where we put up money and then what comes back after it gets matched at the federal level is more to us, so very similar to the way QAF payments work. So we've got a couple of those in there. And, really, this kind of continues to show the thing we're trying to overcome, which is you get a payment and then have to live on it for, 4 to 6 months before the next one comes. And then for me, it's always about controlling kind of how much I let out each week when we're doing AP, because I know it's got to last a certain amount of time. And so, this is just kind of what it's looking like today. And the thing to realize here is also, and like I said, sometimes if I have a low cash day, all of a sudden these numbers can just get a lot closer to, $0 or $1 million versus right now they look, well, it looks kind of healthy. We got a couple $1 million that's always at our fingertips. That's not, truly the way it always feels. But this is also, the balancing metric to this, which is the part that we're still really having to work on, is this is me holding back on AP payments because if I pay them all, these numbers will be below zero. Yeah. So let's go to the next slide. So one of the things I am just always monitoring is my aging, and basically your green buckets are, the current up to 7 days old. The orange-ish is the next 8 to 30 days, and everything blue is, 31 and above, so it's taking us more than 30 days to pay these bills, and in some cases more than 90 days. And, there's a certain amount of volatility just based on when something comes in and gets put into the AP database versus the payment we just made, at the end of last week. But, watching it every week, you can see that it rarely moves very much because I'd need a pretty big cash influx to be able to make a big payment to, bring it down significantly. So this is a challenge because I'm still, we're still trying to wrap our arms around not only how do we get more of the old stuff paid, but how do we not continue to kind of grow that outstanding balance? Next slide. So these are not everything, but just been having a lot of conversation about this and a lot of talk about what are some of the things that we've got to really execute on, what other things can we be looking for. So, productivity and really being able to flex to lower volumes and letting people in the house understand that, when the census is low, everybody's got to find some flexing capabilities and opportunities because we can't just continue to have our fixed expenses at the staffing level at their kind of normal rate. Even though the work may still be there, we can't afford to not have some flexing going on in the overhead department. And so departments are developing staffing grids to kind of think about, when census falls to a certain level, we got to get so many hours out of the day or week till kind of volumes return. We're also doing a lot of work around revenue capture. We're in kind of the early stages of really making sure people are educated on what's, billable and not billable, what things they can do to improve charge capture within their units, how they can help us identify any missing charges by doing revenue and usage reconciliation. So there's there's a group that's meeting that both clinical and revenue cycle folks, really trying to dive into that more. Discharge not final billed. Our pre-cyber attack norm was around between 5 and 6 days. During the height of the cyber attack, we got up to 20 days. We've been bringing it down and gotten it to about the 8 to 8.5 day range, where it's kind of stagnated a little bit. Actually, we must have had a lot of discharges and things go on this weekend because it was up to 10 this morning and up over 10. But, it always goes up a little bit over the weekend when you've had, nobody really working it on Sunday. We do have some work on it on Saturdays. But, we're kind of looking at things there. And again, this is where a lot of, if any, documentation is held up, either for queries or for H&Ps, discharge summaries. It can have a big impact here. So we're looking at ways to call that out more and to kind of help tighten up that process. Also looking at any accounts that are not kind of paying as quickly as we would expect to, working with Guidehouse to collect on some aged dollars. and I just mentioned the physician documentation kind of in line with discharge, not final bills. We're talking about, when we can get some of these initiatives implemented, cath lab, I think we're days to weeks away from at least being able to run some business through there. We're not yet ready to do the PCIs, but there's other things that we can do in their diagnostic cases, things. We're looking at, contracts, both, sometimes contracts cost money, like at some of the physician contracts, but also as we're renewing and reviewing lease contracts, there's some dollars there. The new CT and MRI, they're more like a fourth quarter activity, but, there's volume, so there's incentive for us to get those, going as quickly as possible because there's some volume opportunities there. And then there's a lot of things related to pay practices, not only controlling overtime and premium pay, but also we have a task force that just identifies things that might not be paid correctly, might be being overpaid. So we're trying to really, kind of put some tight actions in place, making everybody more accountable for making sure that it's the right pay. And then, the AP practice, we want to get money, collected as quickly as possible and build up the account so we can make more payments. But in the meantime, we just need to, really be as solid as we can in the payment plans we have, how we spread them out, what our decision-making criteria is. We've started up a weekly AP meeting with senior level executives just to not only have the visibility and understanding, but also to provide input into, we can't pay everybody, what's, critical to keeping the business moving forward. And then also, involving other directors and things because, we want to kind of control the vendor relations and make sure that, we're taking as much into account as we can as we kind of work through the AP backlog. So that was my last slide. And any other questions?
Actually, like, very helpful to understand. Or is that listed in order of priority, like, what could be revenue captured at 80% of the solution to be, or these just various?
They're not, those are some of the higher value ones, probably from a dollar perspective, but, well, I shouldn't even say that because, I would say I've got more dollars than I think should be in aging dollars, halfway through there. Physician documentation holds up a lot of dollars. They eventually go through, but while they're sitting in DNFB waiting to be query to be answered, sometimes it's, hundreds of thousands of dollars in just a few cases. So I would not say these are necessarily in priority order. These are some of the probably most significant ones.
Aging cash collection. Even that self-pay is a small share. My concern is, or going after self-pay, people who can't afford to pay anyways. Is self-pay a big part of our aging that we're going after, or is it more the?
It's not in this. We kind of treat self-pay separately because as soon as it comes in, we send it to an early out, self-pay vendor. If they're true self-pay, no insurance, we send them to self-pay vendor to try to get them qualified for Medi-Cal.
Right.
And we do have quite a good conversion rate there. Sometimes you get a non-response, and then best we do is, try to at least get them set up on a payment plan. We're much more successful on the self-pays after insurance and what is collected, and so our self-pay vendor gets those, 30, 45, 60 days after they've already gone through the insurance collection process. What I'm primarily focused on here is the stuff that still sits with Guidehouse, who doesn't do the self-pay and is, hung up either in some kind of follow-up action or, we're just really trying to dive into what are the main reasons. Sometimes there are accounts that have gone through some kind of initial denial and they're in an appeal or a rebill process. But I'm really starting to, put more and more emphasis on those accounts that are more than 90 days old and still in a commercial bucket or even an Alliance bucket or a Medicare bucket, because Alliance and Medicare pay pretty quickly. And so when I start to see those numbers creeping up, we kind of drill into what's going on here and how can we move through those.
I have a question about the AP payment plans and vendor relations. Is Matco's departure impact that, or is that mostly on your plate?
Well, Matco has been a huge help, so what he's done will be sorely missed, because he spends time every week with AP helping them to figure out, what we think who we think we should be paying, given that, we don't have enough for everybody. And just his knowledge of the vendors and where some of the hang-ups can be, and sometimes even who's a little more willing to give us leeway versus who's a hard stop no. It's part of the reason, but not the only reason, why we started up this weekly AP meeting, which Steve, myself, Phyllis, Jessica, and Desiree, and we may bring in others, that some of the directors we might even invite if they have, critical vendors or things. But it's really why we're kind of upping the ante with how we're going to make these AP decisions, because we will miss Matco's input.
Did that, in your experience, we don't have to turn into, want to get to that normal, like, where are we really out of, like, any of these bullets, where are we really out of the norm? Are we out of the norm more on aging, or are we out of the norm more on physician occupation, or is it just?
Some of it's productivity. Well, I'm gonna call it out of my norm, because I'm used to, this is a smaller hospital than I've worked at before, and I know, that when you're a smaller hospital and your volumes are low, it gets so much harder to be productive, because of staffing ratios. But, so it's the norm for a very small hospital that we probably have the same challenges, but it's low. What's not listed here, because it's a little bit harder to control, so we either, do something different with, future negotiations, is how many things we have that contribute to non-productive hours and dollars, beyond PTO, PTO banks, holiday banks, float banks, legacy banks, this, we have quite a bit of dollars and FTE hours that go to non-productive activities. So that, to me, that feels out of the norm. Our aging categories are higher than the industry standards that you would see at HFMA or one of the standards like that. But when you look at some of the other things, it's like they just feel high because it just feels like money out of reach to us, but they're not necessarily so far off of an industry benchmark. I think because we are so reliant, to get to that financial stability we keep talking about on implementing new things or, tightening up something, which is what all of these other things are besides the implementing. It's like we just really, really have to focus on execution. And that's easier said than done when there's a zillion things going on every day for people. It's like, how do we really stay focused on executing and bringing something to fruition?
Go back a slide to the hey, first question, did we already get our clock in for
That one,
yeah.
co-op payment today, but it was rather small, partially because, you know, we negotiate, co-op payments, what we have to pay. Often we negotiate to only pay a little bit up front or just have it withheld. And, they tend to overestimate the withhold. So today they way overestimated. So they've already confirmed that it we'll see, you know, about 300,000 back next week that we normally would have seen today. But today was like a $1.1 million co-op payment, so we owed $760,000. The one before that, which is the bigger ones that come through the directed payment plan, come in March and October. And we did receive ours in March, but remember that we had taken multiple advances against that, especially during cyber attack. So it was almost like there was not much there to get.
We have not yet taken any advances against it.
We have taken one already against October, and I've done some projecting and talked about potential other ones, kind of depending on how our collections go. We've already kind of paved the road for potentially more.
You got some next one of that already in this model?
Yeah, I've modeled in, where I think I might take one.
April is about to be 154, so it's 860, $5 million. Does that take into account that base off, I don't know, what's this?
This is cash, this isn't budget, so it's all cash. It basically takes into account, what do I expect to go out every 2 weeks in payroll and, you know, retirement contributions? What do I expect, to collect in cash and co-op payments or any other kind of, you know, other, you know, one-off things? And then kind of whatever's left is how much do I think I can afford to let out in AP payments?
That's a bold question. Do they pay directly to us?
They pay to the Alliance, it comes to us, the directed payment ones. They're kind of, the pass-throughs are somewhat fading out, and they're a lot less than they used to be, and the directed payments are the ones that are growing, and so they're come through the managed Medi-Cal programs.
Cash position for April, 3.1 million, unrestricted. That money, is that paid in cash, is that what?
It can run, run somewhere 8, 9, you know.
Any other questions on April financials? On to item number 3, which is the Healthcare District and Power Valley Healthcare Hospital Corporation Consolidated Audit.
Find Gerald, and I'll introduce him. Gerald, can you hear us?
There. Can you hear me okay?
Yeah. All right, so, just a quick introduction. Gerald Tucker is our auditor, as he has been the last few years, so you've met him. This year we felt it would be okay for him to do his presentation via Zoom and save some of the travel time and expense. So I'm going to turn it over to him because we now have a draft and hopefully finished audit for 24. Take it away, Gerald.
Okay, great, thanks. Who hasn't sat through an audit presentation yet in the last couple of years?
From the board tomorrow night, it's just going to be one board member,
Okay.
Alex Friel.
She's not going to be present.
Oh, she's not going to be there tomorrow? So everybody that will be there tomorrow will have sat through an audit presentation.
Okay.
In this room, Kristen's new to us, so she hasn't been through one. And I don't think Vanessa has. So you got a couple newbies on the finance side.
Okay. Well, typically when we are able to report to a finance committee, we try to get a little more detailed make sure, so the purpose of me presenting to you is to have, for me anyway, it's to have you be comfortable with the audit, answer any questions, um, and then get a get to a point where you're okay recommending to the board tomorrow to accept the audit. So that's my goal. So as I go through my presentation here real quick, if you've got any questions, concerns, comments, now's the time. I'm happy to try to answer those as best I can. And then we normally do a bit of a little bit more summarized to the full board, unless there's something you want me specifically to touch on, or if the board has questions or whatever. So again, if you got a question, just raise your hand or jump in, and we'll try to take care of it. Um, so for those who haven't gone through an audit, we an audit presentation before or whatever, let me explain something real quick, or just remind everyone. When an auditor comes in, our our main job is not to say whether or not the hospital had a good year or a bad year, or whatever. Our main job is to just basically say, are the numbers being reported accurately and within generally accepted accounting principles? So it's really not, I mean, we do get involved with and we'll talk about that a little bit here with a going concern, but we don't really, we're not there to audit how well you're doing. We're there to audit how accurate is the reporting of what you're doing. Does that make sense? So kind of keep that in the back of your mind. So you've got a consolidated financial statement here that we deal with, and that's just the nature of how these entities are put together because of the district and the relationship with the hospital. So you've got the district and the hospital, both are included on this in the audit. So with the audit, then there are four things that we have to report to the board. We'll talk about them here too to make sure you're comfortable. But we have to report as an auditor to the board. First off, we have to talk about what kind of audit opinion did we provide? And you receive two audits. You receive a regular financial audit, both for the hospital and the district receives what's called a governmental audit, because it's actually a governmental unit. And for both of those audit reports, you received an unmodified or a clean opinion. So that's good. And then the next thing we have to report is, as we go through all of our testing and looking at the documentation that's been provided us and the entries that have been made and so on and so forth, if we see any material weaknesses or significant deficiencies in the the district or the hospital's internal controls, then we have to bring that to your attention. We had no issues with any of our testing, and none of that came to our attention. And also we have to let you know if there's any reportable findings. That would be anything that's considered illegal, or a defalcation, or embezzlement, or purposely filing false reports or whatever. And all through all the audit documentation, we had no issues of that at all. Um, so and number three is, there were no audit adjustments. There were a couple of late client entries. The difference between those is kind of important. An audit adjustment is where basically we get the financial records, we go through them, and we find errors, and we have to correct those. Versus the audit started, and the client is still working on stuff and coming up with entries, and then we audit those entries, and they go ahead and post them. So there was still a number of things that were open once we started the audit, getting the bonds closed for the first year, and all the related entries that come with that, and the lease entries and so on and so forth. And I'll talk about that a little bit later. But so there's some late client entries, no audit adjustments, no issues there. And it was really pretty minimal when all the entries were booked. There wasn't a material impact on the financials. And then the fourth thing we have to do is, if there were any difficulties encountered with management in performing the audit, disputes, disagreements, or they weren't able to or wouldn't provide us with the documentation that we requested. And but no issues here. The staff does a great job getting us what we need and in a timely manner. And Julie and her staff actually do a really good job. It's been nice because pretty much Julie's entire staff has been pretty much intact for the last couple of years or since the start. So they pretty much know where all the bodies are buried and everything else. So we can get through and uh, things are done quickly and cleanly. Everything we ask for is provided for us. Everything pretty much is provided electronically, which works well with us. And so the audit went well. We have no issues or problems. Any questions on those four items? Okay. A couple of significant accounting issues that we worked with this year. I already mentioned that it's a consolidated. The hospital is actually called a component unit, if you hear that um, term kicked around. And basically, it's because the district and the hospital, they're so intertwined, they share management and so on and so forth. And so based on governmental accounting, it has to be included. That's why that's included. And so it is a consolidated and has both entities involved in it. There is a going concern issue, a going concern blurb in the report. It doesn't go to the level of a modified opinion or a anything other than a clean opinion, because we still have the numbers are still accurate, they're still presented properly, and there's no other issues that impacts. Basically, we just have to show that given the financial at the end of the year when we did the audit at 12/31/24, uh, there are certain things that days cash on hand and certain other things that would cause would cause a reader of the financials to say, I hope they're going to make it through the next year. Now, having said that, I think you are going to make it through the next year. I think you're moving in the right direction. You're trending in the right way. As Julie just did in her presentation, a lot of the things you have control over, you're doing a great job of budgeting and controlling. Unfortunately, even though it's kind of a morbid thing, you don't have control over volumes sometimes. I mean, as long as you're getting the vol, you don't have much competition right next door, or a bad reputation, and patients are fleeing the area. Um, it's hard to hope for more volume, but hope for a healthy community that you serve, if you know what I mean. And sometimes just volumes are what they are. But from a going concern issue, I would think based on the direction you're going and what's going on, I would hope this is the last year we have that. Of course, a lot of that will depend on the fruition of the budget and other things that Julie spoke about earlier. Any questions on about what a going concern issue is or why we have that little paragraph in there?
Joe has one.
My question's
Yeah, yeah.
not a general question, it's a specific question to us. Does it impact any of our financial situation, for instance, bond or the loan?
No, you have certain covenants in your bonds and whatnot, and we also look at those and make sure that you meet your covenants. Or if you have it in the future, if you don't meet a covenant, that you get an exemption or whatever. Um, the issue would be if we weren't able to get accurate numbers from you, or they weren't reported in accordance with generally accepted accounting principles or GAAP, that would be a problem. Just being a going concern, they saw your financial statements last year when they approved the bonds and got them going forward. So they work through this. You still have good numbers, and what they're going to be looking for is trends and the direction you're going, and are you making improvements and moving in the right direction versus, they don't expect you to, turn it around in a year. But anyway, does that answer your question? Okay.
Yeah, thank you.
Okay.
One
Yeah, go
more
ahead.
question.
Yeah.
So how does this, is this concern due to also the cyber attacks? Because this is a calendar year 2024, does that kind of bring into effect that?
Yeah, there's multiple things in the written thing, that kind of talk about the various things that affected operation.
Got it.
Main thing that affects a going concern is cash. Do you have enough cash to cover your liabilities? Do you have a projection of cash coming in, revenue? Are you going to be billing and collecting and so on and so forth? Obviously, with that cyber attack or whatever, that impacted your cash, as Julie talked about. It impacted your ability to bill and collect and whatnot. So it can have an impact, but having an attack alone is not going to kick you into a going concern, but it sure can exacerbate some of the issues that will affect whether or not you're a going concern. Does that make sense?
Yes.
Okay, all right. Um, so the big issue this year, other than my guess is for Julie and her staff, that cyber attack was probably a huge, a huge issue. We had another client that had one as well that impacted it was at the beginning of last year, and they're a different year in, but it really messed them up for a couple of months trying to get reporting out and different things. So I know what a headache that can be. But from an accounting standpoint and from an audit standpoint, the big issues this year were obviously the issuance of the general obligation bonds. Julie talked about that a little bit already, and I'll just touch on that. We look at those bonds, and one thing I appreciate with Julie and her staff is they went through, they analyzed the bonds, they put together all the entries, and this wasn't during the audit, this is just during the year. And then we were conversing and reviewing and talking and making sure that those entries were made and they were made correctly from our standpoint as well, which really helps when we get to the end of the year with the audit. Then there's just a little bit of cleanup instead of major cleanup. Uh, with we're involved throughout the year, which helps the audit go much better. So the bonds have been booked. They were issued. You got 53, what is it, $53,350,000 in general obligation bonds. That was all booked. The liabilities booked. And then you took all that cash and you bought the hospital. That was about a $40 million transaction. That's all been brought onto the books. So you got the debt, you got the hospital, and the difference is sitting in assets as use is limited, and that's for the remainder of the plans for that additional 13, $14 million. What will happen going forward is yes, the debt sits on your books, the assets sit on your books, but the county will ramp up and they'll get going this year, and they will bill through property taxes every year. Money will come in. County will kind of act as your escrow account. They will collect the money. They will pay the bond payments, interest and principal payments for you, and get a report to you and let you know what's going on. And then going forward, you'll have the principal payments, the interest payments made. You'll have interest expense, obviously. You'll have depreciation expense on the new assets. And you will recognize what's called district tax revenue related to the GO bonds. To the extent they collect money and pay money on behalf of the hospital for principal and interest payments, that will become income, district tax revenue for you each year going forward until the bonds are paid off or defeased at some point in the future. And so, it gets a little bit of a technical accounting issue. Uh, you know, Julie and her staff did a great job. Um, research, staying on top of that and making sure that everything was booked, booked correctly and so on and so forth. So no issues there. Um, Part of that whole, with the bonds and the purchase, up until now, you had right of use lease assets and right of use lease liabilities for the leases you had. Well, now you own those properties. So the majority of your operating lease, those right of use assets that we had on there, those assets have been transferred to actually owned assets, and the liabilities are gone. And now you just have just the bond liabilities. And so all that was, and it might be a little confusing, but all that was booked properly. We took a good hard look at that and make sure that was all done correctly, and it should be fine going forward. And again, like I said, Julie touched on that as well. Any questions on those items? Anything else you noticed in the draft you'd like me to address? Um, want want you to be comfortable with the audit and comfortable with, with what we look at and how if something in there, you're questioning something in there and want me to explain it a little bit more or how we look at that number, we can certainly do that. guys are an easy crowd.
Yeah, I don't see any questions coming up. I read it, and I appreciated the context behind it. I'm not sure everybody always takes me up on this, but I'd encourage everybody who's affiliated with an entity to read their actually, it's more than the financials. This is a lot of really important grounding information about how we accrue stuff and what legal liabilities are, and it's really informative document that we're intimidated by, but there's a section in the notes that I encourage everybody to read that note section, because it's really good basis of who we are, what we do, and some of the things that impact us.
Yeah, I would agree, especially, going through the bond stuff. There were certain things when I would be looking at the tables or and kind of going back and forth between the notes where I was sending questions going, what does this mean? Because I was like, just the terminology is a little different, or, sometimes you just catch something that kind of got translated incorrectly, and it's like, wait a minute, I don't think, that happened, and then we'd be able to correct it.
Well, all those agreements are written by attorneys, right?
Yep.
Unless you're an attorney, sometimes the wording gets a little convoluted, or I try to figure out what are they actually trying to say here, or what are they trying to. But anyway, yeah, we got through it all. And one thing too, I was going to touch on. You're involved in these. You've heard of HQAF and QAF and these different programs that Julie's talking about, QAF, and I'm sure but those are great programs. And Julie and her staff are positioning the hospital and the district to be able to participate in those. And that money is a great supplemental source of cash for hospitals in California. It's basically a huge supplemental program for Medi-Cal, and so the more you can identify the volumes and participate in that program, it will certainly help the bottom line and the cash flow of the hospital going forward. Anything else?
I don't see any other comments or questions. I think we're ready to pass a motion approving and forwarding the holiday audit report before. So moved.
Second. Thank you, Director Gallagher.
Okay, great. Is there anything specific you want me to touch on for the board, or just kind of give a little bit quicker version of what I did here and off we go?
No, I think you did a great job.
I'd always emphasize with the board, identifying that you are required to disclose going concern issues. It's not difficult, but we do have a plan. That's a good thing. I appreciate your framing of that, how you framed that here, and I think that's important tomorrow. That is not normal. Not normal to have your financial bill, your audit financial going concern issue, but that there is a plan, and you've done a good job with some staff to document that. And I think the second part is always assuring the board that we're hearing from you if there are any issues that you see or staff are being non-compliant, whatever today.
Right.
I expect this to be cases that it's been very helpful, very forthright, very transparent. So I think those two are always really important to the board to us here.
All right, sounds good. Then I can see probably most of you, if not all, tomorrow evening via Zoom.
Thank you.
Excellent. Thank you,
All
Joe.
right, take care. Thank you. Mm-hmm.
It was good to see one of our reports.
Yeah,
Oh, so we have a motion on the floor.
we do. Do we want to take it back to public comment? Or we vote?
Yeah, any comments? Comments online, any hands raised?
Hands raised. All right, I'll take roll on the item. Director Gallagher?
Yes.
Julie Peterson? Yes. Chair Pimentel?
Item number 4 is our other district volunteer training program.
Okay, and basically what I'm asking for is, to pass a resolution that will allow myself or Steve to execute this agreement for what's considered the CY 2024 Voluntary Rate Range Program, Intergovernmental Transfer Agreement. Basically, this is a program that does run through the Alliance, and so we've been working with, our vendor that helps us with, QAF and DISH, and get into new programs, both in the investigation and then also kind of in negotiating, how much can you get into this, because it's all about how much you can contribute to then be able to draw back the funds. So what we have now been presented with is a intergovernmental agreement regarding transfer of public funds that we will execute that says we will transfer for this program $500,000, roughly $500,000. There's always an exact number because they do the calculations right up until the point you transfer it, plus a non-refundable 20% assessment fee, so it'd be about $100,000 that will go to DHCS by November, and then they will send those funds up, get the federal funds back, and somewhere around February, we're saying Q1 of '26, we will receive those funds. They'll go back to the Managed Medi-Cal Plan Alliance, and then they will transfer them to us, and we should see about $1.3 million. So we'll turn $600,000 into $1.3 million. And this is really the first of, there's two different programs we're trying to get into. This motion is only about, a recommendation is only about passing this one, but it is our hopes to then parlay some of that money into the contribution for the next one to bring more money down, and then as we continue to strengthen our financial position over the years, we hope that we'll be able to contribute more up so that we can get more back. And that, we do use a vendor to help us through this because they really know the right people to talk to, the right ways to frame things, to get the right players as far as we've gotten here. So what's attached is the agreement that we've reviewed, and with your authorization, we will execute it before their deadline, which is actually an August 1st deadline, but we want to just get it in.
And it's not the authorization of this group, it's the authorization of the board.
Yes, thank you for that.
The board would be authorizing it, not this group. So, yeah, just a review and forward for this group.
It's just the time lag of these programs. They run in a lag looking.
Make sure we're good and they're good.
Yeah.
And shorter expiration than I expected. Was there any? Did you get the sense from anybody that could go along with it?
Well, we will, we will continue to work with, get through this one, and then be able to, hopefully petition or ask to be able to increase it. Because every time we have to go back, and the vendor did this for us, to go back and work with the Alliance in terms of what's within their, overall bucket that can come back through us with their caps. And it's much more detailed than I know how to articulate. But, yeah, I could ask more questions because I can't really explain why it's a June 30th, 2027 date, but I think it is kind of an evolving,
I don't think it's the highest priority.
yeah, thank you.
This record, I'm not sure.
Yeah.
Before that, end of that.
Yeah.
Period is around.
And we have, basically already had the conversations, because we meet with our vendors every pretty much every month now, because there's been enough activity, where they're always kind of watching out for what's the next milestone we have to hit, what's the next either data point we have to provide, or, they'll make sure, believe me, if I didn't have this signed off by July 1st, they'd be probably knocking on the door every couple days. They're pretty good about that.
I wear my hospital hat as I see this, recognizing this is money coming from ultimately the federal government for the non-federal share Medicare that goes to the we get money, there's less in the pool, the big pool contributor is the county historically. County's got, we see almost entire allocation. That's not normal for counties to use entire amount, but it is more normal for a hospital like us to get that portion. There will be some friction points over time, as ours increases, they'll decrease the county's share that they're in.
County gets some share of cost of these.
Of the IGT, I believe it's 100% has gone to the county for a long time since the late 2000s. And so now that we're entering the pool, there's less. The county share will go down as our share goes up. The county will lose. I'm saying this from my Watsonville.
Yeah.
It's good number, this is normal. Also like that. But there'll be some conversation, I'm sure.
Can I ask, is any shopping mall? Federal funding? Who knows?
Yeah. I think this particular program has not even been funded anymore yet. Medicare in total has.
Sure.
Yeah, I won't speculate. At a basic minimum, they were talking about making sure states take up a bigger share of their costs. So the dotted line means the IDC goes more, our share going up.
Who we recommend? Deciding authority.
And who will be the signers?
Well, right now,
Delegation?
the agreement has my name on it.
Yeah.
So I likely will, and Steve is copied on, but actually, either one of us could sign it, I'm the main point of contact, and he's the copied point of contact, but actually a blank line, so either one of us.
Look at, tomorrow, maybe go to and mind sending your, putting in the minutes, your motion to authorize this, Julie or her delegate so that she can, that she has the application.
And I believe that's in the board, yeah, that's in the board recommendation.
We have
So
Julie and Steve.
for this group, it would just be a nothing as far as motion goes, or to just to have the recommendation to forward.
Recommend forward.
That's
We
second.
don't even,
They don't. Going.
Thank you.
thank everybody for your time, this is a long one, so it's giving me a lot of discussion for the team. We are ready.
Thank you.
Thanks, everyone.
Actually, it's a related question. With this